The modern public corporation is a marvel, right? It can raise tons of capital, become huge beyond anybody's imagination. It can span the globe. But it does come with its costs. There are all these different interest groups often pulling in different directions. So one of the problems you face as a stockholder in a publicly traded company is assessing what those potential conflicts of interest are and how they might affect you in the future. This is really a webcast about you as a stockholder and what you have to worry about in the future. You have enough on your plate, I know, right now, but you want to think about those conflicts when you think about investing in a company. So here's what I'd like to do. I'd like to take a company and look at its existing stockholder base and form some judgments about the potential problems I might face as a result of that stockholder base in the future. The first step in this process, obviously, is collecting that list of stockholders in your company, the biggest stockholders in the company. And there are quite a few options today, more than there used to be 10, 20, 30 years ago. Some are free. You can go to Yahoo Finance or Morningstar and look to see whether you can find who the major holders of your stock are. So in Yahoo Finance, for instance, if you can find your company and you go down the left-hand side, you'll see a link to holders. You click on that, you'll see the major holders of stock in your company. You can go to Morningstar, get a similar breakdown. Now, if you can go up the scale, you can go to Capital IQ and get much of the same data under holders for any company. Or if you're lucky enough to have access to a Bloomberg terminal, things get very simple. You find your company and then you type in HDS. If you do, you're going to get a page that looks like this. This page actually lists the 17 top stockholders in your company. And it's quite amazing. You can pull this page up for pretty much every company on the face of the globe that is listed on Bloomberg, and Bloomberg pretty much carries all of them, and you'll see this data show up. In some countries, it's more reliable than others, as you will see in a minute. This is actually the page that I pulled up for Clorox, and this was a couple of years ago. Let me go through this page because the structure of the page remains pretty much the same today. In the very first column, you see the holder name. That's the name of the group that actually holds the stock. In the second, you will see the portfolio that they hold the stock in. So a company like State Street has dozens of funds. This just lists out, if possible, whether they can isolate the fund. In most cases, as you can see, they don't have that isolation. In the third column, you see source. You're saying, what's that? Well, Bloomberg doesn't collect this data. It actually pulls them from public filings. So for US companies, these filings, this data is pulled from a filing with the SEC called the 13F. That is a filing made by mutual funds, pension funds, institutional investors to the SEC listing out the companies they own. So as you will see, looking at Clorox, every one of the top 17 stockholders in Clorox is essentially an institutional investor. The 13D is a little different. It's an institutional investor, but as you can see, they're both ICANN capital, so they don't quite make the threshold of a mutual fund or a pension fund. Those are ICANN's vehicles for investing in Clorox. In the next column, you see the amount held. That's the number of shares held in this company by that holder. So State Street, for instance, holds 7.146 million shares of Clorox, and the column after that gives you the percentage of the outstanding stock in Clorox that is held by State Street. So 5.42% of Clorox is held by State Street. In fact, if you add up the top 17 stockholders, you get a sense of the concentration of ownership in this company. So if the collected number is 80%, the top 17 stockholders own a big chunk of the company. If it's only 20% or 25%, it's a smaller concentration. The latest change is the change in that ownership from the last filing. So these are the shares. So if it's a negative number, that's the number of shares that State Street sold off, 17,404 shares, between the previous filing and the most recent filing. And the last column gives you the date of the filing. Thing to note here, these are not real-time filings. So in the sense, they reflect whatever the last date of the filing was. So if you're in November or December of a year and the last filing is in September, there might have been a fairly significant shift in holding over those 2 months. Not much you can do about it, but at least be aware of it. So here's what I'd like to do. I'd like to provide a kind of list of 8 different scenarios that your company might fall into based upon what the top 17 stockholders in your company look like. Hopefully I will cover the spectrum, but odds are your company might be a really unusual company, in which case you might have to adapt one of these 8 scenarios for yourself. So this page actually lists out the 8 possible scenarios I'm going to go through. I'm going to start off with what I call the institutional default. That's basically what you saw with Clorox. All 17 stockholders are institutional investors, and for many large market cap companies, that's going to be true. The second is a very strange scenario where when you look down the list of top 17 stockholders, you will notice your own company's name pop up there, either as itself or as its treasury, stock held by its treasury, or in some cases by a pension fund for the company. We'll talk about what the potential problems are there, but that's the second scenario. The third scenario is when you look down that list of the top 17, and the very top, or the second from the top, the biggest investor is the government. When might this happen? It might be a company that was privatized 20, 25 years ago, where the government still retains an influence, or a company where the government actually acquired an influence. The fourth group of companies are companies where you have two classes of shares. One with high voting rights, one with low voting rights. Used to be unusual in the US, but starting to become more common after Google went public with this particular structure about 5, 6, 7 years ago. Then you have family group companies, where essentially these are companies that are part of a group. Very common in Asia and Latin America. We'll talk about what the structure looks like for these companies and what the potential conflicts of interest are there. Then there's a group of companies where the founder will show up in the companies. And you can think of the Oracle with Larry Ellison, Dell with Michael Dell. Basically, these are the founders hanging in there. They originally used to own 100% of the company. They took it public, and they own a chunk of the company still because they haven't sold off their entire stake. Then there's a seventh scenario where you look down the list and you see another corporation on top of the list, holding this company either as a strategic investment or a financial investment. Creates its own potential conflicts of interest. And the eighth and perhaps most interesting scenario is when you look down the list and you see a name that you recognize. In fact, looking at Clorox probably doesn't fall into the institutional default because the name that popped up on that list, Carl Icahn, is a name familiar to those people who track activist investing. These are investors who essentially take a big stake in a company and try to change the way it's run. Now, as a stockholder, you might say, well, why should I care? We'll talk about what the potential issues are that come up with each of these scenarios. Let's start with the first one, the institutional default. Here's a company that, this is a fairly recent, I pulled this up early this year, this is the start of 2013, Hewlett Packard. You look at the top 17 investors, what do you see? You see 17 institutions. That's pretty much the institutional default. So what does this tell you about Hewlett Packard? Here's what I would think. And remember, this whole process is about asking why you should care as an individual investor. As an individual investor who owns 1,000 shares of Hewlett Packard or 10,000 shares of Hewlett Packard, you know you have little chance to be hurt. In fact, you can scream as loud as you want from your rooftop, and the manager at Hewlett Packard would not care. So the question you're asking is, looking at this list of top 17 stockholders, is any of these stockholders likely to step in and confront management when they do the wrong thing? Now, I look at this list and my stomach drops. When I think about institutional investors, even the very large institutional investors, or maybe especially the very large institutional investors, we know what their first inclination is. When there is trouble or when they don't like the way a company is run, they don't stand and fight. They sell and move on. And I don't really blame them for that. A Fidelity, for instance, cannot fight 150 different fights. They don't have the resources to do it, and they have other interests at stake, whatever those interests are. So it's very likely that when I look at this list, I'm going to conclude that in this company, managers are essentially going to rule the roost. There's going to be very little counterweight to what managers want to do. That might explain a little bit of what you've seen at Hewlett Packard for the last few years, where corporate governance is weak. The board, in a sense, rubber stamps what the CEO wants to do. Maybe it's very much a reflection of the stockholder composition of the company. So that's the first scenario, is your company looks very much like Hewlett Packard. All the top 17 stockholders are all large institutional investors, and none of them is particularly activist. Here's the second scenario. Okay. Let's take China Mobile. You look at the top 17 stockholders and look at the very top of the list. Who do you see? China Mobile. You say, how can that be? How can a company be its largest stockholder? In fact, anybody who's tracked Royal Dutch for a while knows that this is not new to the corporate world. Royal Dutch for years used to have shell companies that own shell companies that own shell companies, that ultimately at the bottom of the list you'd have an operating company. You say, why would they do that? It sure does complicate matters, right? And that's exactly the point. Sometimes when you see complexity like this, there's a reason, and the reason is it allows these companies to be controlled without anybody assaulting that control. It's a control device. So when you see a company's name pop up right up on top of the list, one reason might be that it's essentially a control device. Here's the second possibility. With Japanese companies in particular, you'll often find the Japanese company's name itself on the list of the top 17 stockholders. For a while in Japan, Japanese companies were allowed to take their own cash balance and invest it back in the stock of their company. It's very different from buying back stock. In buying back stock, you buy shares in your company, but those shares go off the books. In the case of Japanese companies, they would use cash to buy shares in the company, and they'd continue to be big stockholders in the company. Create some potential conflicts of interest because those shares are now controlled by the company's managers and potentially could be put to the wrong use. There are usually restrictions on voting rights on those, but it's still a problem. So that's the second scenario, is if companies are allowed to invest their own cash balances back in their shares, not in the sense of buying back shares, but as investments. And there's a third possible scenario. Some companies, when you look down the list, you'll see the company's pension fund show up as one of the largest single stockholders in the company. What's happening here? You're a large company, you have a pension fund. That pension fund has to invest its money somewhere so that it can in a sense pay the benefits that it's promised the employees, right? It's usually not a good idea to take employee pension funds and invest them back in the company in which the employee works for a very simple reason. If the company goes down the toilet, then the employee not only loses his job, but he loses his pension. But without debating why companies do it, sometimes you'll see an employee pension fund show up on the top 17 stockholder list. You're saying, why should I care as a stockholder? Think about it. If the pension fund for the company is the largest single stockholder, and that pension fund is interested in making sure that employee benefits get paid, it might have a very different set of interests than you and I as stockholders in the company. Again, a potential conflict of interest which might show up in the actions that you see in this company next year, 2 years out, 5 years out, 10 years out, further down the road. Here's a third scenario. Okay? This is GDF Suez, very old French company. You look at the top stockholder in the company, it's a French state. So this is not unusual. You'll often find this with European utilities, which until 20 or 25 years ago used to be government-owned companies that have become privatized. The government is the largest stockholder in the company. Is this good for you or bad for you? Well, there are potential good scenarios that might emerge from this. One potential good scenario might be that if this company gets into trouble, the government will bail it out, right? But there are lots of bad scenarios too. What's good for the government might not be good for you as a stockholder. Let's take a couple of very simple examples. If you're a company and if you're a stockholder in a company, you probably don't want the company to maximize taxes paid to the government, right? You don't want it to break the law, but you don't want it to maximize taxes paid. Unless, of course, the largest stockholder in the company is the government, in which case the government might want you to maximize taxes paid. Because even though it pushes down the value of their holding in this company as a stockholder, those taxes go to the government. Or another scenario, what's best for your company might be to move the company's manufacturing facilities to a different country. That might lower costs, increase profits. But if the government is the largest stockholder in the company, they might have a say in that process, saying, hey, not so fast. When you move those manufacturing facilities, employees will lose their jobs. Those employees happen to be the voters that we have to worry about as the government. So they might step in and say, not on my watch. So if you see the government as a large stockholder, think through the consequences, because there will be consequences down the road. There's a fourth scenario. It's top 17 stockholders in Facebook. Notice something strange here? You don't see Mark Zuckerberg on that list, right? And we know Mark Zuckerberg controls the company. Saying, how can that be? These are the top 17 stockholders in the shares you and I would buy in Facebook, which are the low voting rights shares. The high voting rights shares, which are not traded, not as liquid, are held by Zuckerberg and a few insiders. Essentially, in companies like this, you don't even have to go very deep, because the question you're asking is, how much power do I as a stockholder have in this company? The answer is right there in front of you. You don't have much, because these are the shares with the low voting rights. As long as Zuckerberg controls the voting shares, he can essentially run the company in his best interest. You're saying that's good, right? Because he's a stockholder, a big stockholder. Well, some of the time it can be in your best interest to have Zuckerberg do this, but sometimes what's good for Mark Zuckerberg might not be good for you, right? And if it's not, there's not much you can do about it. You own the non-voting shares of the low voting shares. There's no role you have in how this company is run. So as I said, this used to be unusual in the US, but it's becoming more common. In fact, pretty much every social media company out there has two classes of shares. And as I said, Google started this process with two classes of shares. There are some older companies around, News Corp, Ford, that have two classes of shares. But this is something that might be much common in some in other countries. In fact, much of Latin America used to have two classes of shares. They used to be called common and preferred, but preferred shares in Latin America are actually common shares without voting rights. So this is actually not uncommon outside the US. Now let's take a fifth scenario. Okay? This is Moet Hennessy, well-known luxury company in France. And if you look at the top 17 stockholders, you see Groupe Arnault. The owner, the control of this company is actually in the hands of one guy, Bernie Arnault, and he basically controls not just this company, but a bunch of other companies. If you look to the left, you see a very complex holding structure. That's the structure that he's constructed to keep control of all of these companies without having to own 51, 55, 60% of these companies. He's saying, I can't make any sense of this. I can't either. Essentially, that's the point of the exercise. By having this cross-holding structure, he's essentially insulated himself, immunized himself from outside, from acquisitions, from control threats. He essentially controls all of these companies with that cross-holding structure. And as I said earlier, sometimes when you see very complex holding structures, the objective is to control the companies with very little, because the rest of the world doesn't know what you're doing. They really can't challenge you on how well you're doing it. Here's a sixth scenario. Incidentally, on the family group companies, sometimes they're easier to catch than others. In fact, if you go to India and you look at the Tata Group, every company in the Tata Group has Tata as part of its name. So when you see any Tata company and you look at the top 17 stockholders, you'll often find 5 or 6 other Tata companies in that list. Essentially, again, a structure where the family can control all these companies without having to own 51, 60, or 65% of these companies. It's a control device that makes it very difficult for outsiders to break through. The other thing to remember about family group companies is if you look forward, given that the family controls the entire group and their interests are in how the companies collectively do as a group, they might put the group's interest. In fact, let me take the might out. They will put the group's interest above the best interest of the company. So sometimes you might find a Tata Chemicals or a Tata Steel do something that does not make sense from their perspective as a company, but makes complete sense if you think about what's in the best interest of the group. Here's a sixth scenario. Okay? This is Las Vegas Sands, a casino company. Look at the top stockholder, Sheldon Adelson, the guy who founded the company. And he owns a pretty substantial chunk of the company still, 51%. So essentially, sometimes you'll see the founder owner hanging in there, and you can think of some big names. You think about Bill Gates and Microsoft and Larry Ellison and Oracle. As companies age, you see the ownership start to break. You saw that with Walmart, where Sam Walton owned a big chunk of the company. Now that ownership has been split up among the Walton clan, 5, 6, 7 different Waltons, and in the next generation will be splintered even more. As companies age, the founder will drop down the ranks. Sometimes they turn over the shares to a foundation. The Hershey Foundation is the largest stockholder in the Hershey Company. So sometimes they turn it over to a foundation, but this is part of the life cycle of companies. Founders hang in there. And as a stockholder, you got to ask yourself, is this good for me or bad for me? Well, there's good news and bad news. The good news is when the founder is also the CEO of the company, you can wager that this founder CEO doesn't think like a CEO manager. He thinks like a stockholder. Sheldon Adelson doesn't ask himself, now how good do I feel as a manager of Las Vegas Sands? He's got too much at stake. But don't get too carried away. There can be a negative to it as well. What's good for Sheldon Adelson might not be what's good for you as a stockholder. Let me give you an example. In the last quarter of last year, Las Vegas Sands paid a huge special dividend. Now you're saying, why did they do that? Well, they were worried about the fiscal cliff. But I shouldn't say they were worried about it. One particular man was very, very worried about the fiscal cliff because he was in the highest tax bracket, Sheldon Adelson. He paid us a huge special dividend. This is in a company which a couple of years ago was in financial distress. You can say that makes no sense. A company in financial distress paying a large dividend, not in the best interest of the company. May not be, but it's in the best interest of Sheldon Adelson. So what's good for insiders might not be what's good for outsiders. Let's keep moving. So, seventh scenario, you look down the list, and at the top of the list, you see other companies. Okay? So, in this case, for instance, I have a French company, and you look down the list, you see other companies in France being the largest stockholders in this company. But this is a little abstract. So, you're saying, let me take a simpler example. If you take JetBlue and you look at the top 17 stockholders, and you look at who's on top of the list, you know who you're going to see? Lufthansa. Now, why would Lufthansa be a big stockholder in JetBlue? Not because they're a financial investor, but because they view this as a strategic investment. They want to make something of this partnership. And they're saying, so what? Why should I care as a stockholder? Let's say you've invested in JetBlue. And let's suppose 6 months from now, 1 year from now, Lufthansa decides to have some kind of joint venture with JetBlue. And let's say this joint venture is tilted in Lufthansa's favor. Hey, they might push it through, even though JetBlue might be made worse off by that joint venture. As the largest stockholder, Lufthansa might push for it. I'm not saying it's going to happen, but you have to be ready for whatever comes down the pike. So that's something that could happen. And if you have a company as the largest stockholder, remember, companies don't have money. Basically, they're investing their stockholders' money. So Lufthansa is the owner of JetBlue, but it's actually Lufthansa stockholders who are the investors in JetBlue. Might make good sense for you to print off the HDS page for Lufthansa and see who the top stockholders in Lufthansa are there, because you might want to trace the conflict back to its source. Which brings me to the final scenario. You look down the list and you see a familiar name. So in this case, I picked a French company, Dan. And you go down the list and you say, I don't see any familiar names. Take a look at at what's number 13 on the list, Trian Fund Management. I'm sure you've never heard of Trian Fund Management, but that's the front for Nelson Peltz, who is an activist investor. You say, how would I have known that? Well, I just Googled the name up. So in a sense, it's good to know what the fronts are for different activist investors. So for Nelson Peltz, it's Trian. For Bill Ackman, it's Pershing. So you can basically find for each investor what the front is for that investor. Once you've isolated that and you find that name on your list, if you're a stockholder, this is good news for you. You're saying, why? It's not because Nelson Peltz cares about you as a stockholder. He couldn't care less. He doesn't know who you are. But here's what you're hoping for. As a large stockholder in this company who's willing to fight the good fight or the bad fight or any fight, essentially challenge managers, you're hoping to piggyback on what he does. So if you have a company which is set in its ways, will not borrow money or will not take projects, will not expand into Asia, you want somebody rocking the boat. And it's good to see a name like a Nelson Peltz or a Bill Ackman, even if they're behind this front of Pershing or Trian or whatever their choice is of fund. It's good to see that name on the list. And if you own Coca-Cola, you look down the list, you're probably going to see another familiar name, Berkshire Hathaway, which of course is the front or the name. If I say Berkshire Hathaway, the name that comes to mind is Warren Buffett. Is it good to have Warren Buffett as a co-stockholder in the company? I think so. He might not be an activist in the sense that Nelson Peltz or Bill Ackman are activists. In the sense he doesn't challenge managers to change as much, but I would wager if they did something really stupid, he'd step in and say, maybe guys, you shouldn't try to do that. So what's the bottom line here? You're a small stockholder in a company, you don't have much of a say. So what you're looking at when you look at this list of top 17 stockholders is, hey, is there somebody in this group who might make a case for me? Not because he thinks about me, but because it's in his best interest and then I can piggyback on his best interests. You're also looking at other potential conflicts that could hurt you. As I said with the government, that you'll end up paying more in taxes. Is that a terrible thing? It might be, but since there's not much you can do about it, all you can do when you see a potential conflict of interest is think about the consequences. What do I expect to see as a consequence of this conflict in terms of investments, in terms of financing policy, in terms of dividend policy? And then you incorporate that when you value this company. So you're valuing that company for the world you live in, not the world you wished you lived in. You value the company given the conflicts of interest, which means you might end up with a lower value for a company with much bigger conflicts of interest. So that's the webcast for the week. I hope you found it useful. Thank you very much for listening.